Hey guys, today we're going to talk about one of the best trading setups in smart money concepts, the power of 3, also known as AMD. In this video, we'll explain what the power of 3 is, how to identify it on the chart, the rules and tips for making high-quality trades with this setup, and we'll break down multiple real chart examples. If that sounds interesting, don't forget to smash the like button to support us in creating more videos like this. And if you're new, make sure to subscribe to our channel. Come back. Let's get started. So, what is the power of 3? The power of 3 is a trading pattern that breaks down price action on the chart into 3 major phases: accumulation, manipulation, and distribution. The accumulation phase, as the name suggests, is a period of consolidation where the price lacks a clear trend. During this phase, the price forms equal highs and lows, gathering stop losses and liquidity above or below these boundaries. Depending on the time frame, this phase can appear in various formations. For example, on a higher time frame, the chart might look something like this. The manipulation phase, on the other hand, refers to a situation where the accumulation phase is followed by a failed breakout, also known as a fakeout. So, what is a fakeout? In basic price action, we know that when the price breaks below a support level, that level often becomes resistance and pushes the price lower. This happens because of the behavior of market participants. When the price taps into this area, traders who previously went long there see it as an opportunity to close their positions without taking losses. At the same time, traders who missed this downward movement see this as a chance to enter short again. This double action causes the price to reverse from this area. However, if the price doesn't reverse and instead quickly moves back into the range of consolidation, we call it a fakeout. Fakeouts can provide some of the most accurate price predictions. A fakeout signals that the breakout was not genuine and was engineered to sweep liquidity below the range while inducing breakout sellers into the market. Once smart money has collected enough liquidity, it's usually followed by a sharp move in the opposite direction. This is known as the distribution phase. The distribution phase is when we open our trades. As smart money traders, we aim to enter the market after stop losses have been triggered. So basically, here we have accumulation, manipulation, and distribution. Similarly, in a bearish scenario, the market forms a consolidation, followed by a breakout to the upside, which engages the liquidity above these equal highs. If the price quickly returns inside the range, it signals a fakeout, and the power of 3 pattern completes with a sharp move to the downside. So, how do we enter a trade using the power of 3 pattern? We aim to enter trades after the manipulation phase is confirmed. First, the price must return inside the range, which confirms the failed breakout. We mark the close of these candles as a reference for the consolidation area. To confirm the entry, we need a break and close back inside the box. The stop loss should be placed above the swing high, and we can target important levels ahead of the price. However, there are times when the price moves sharply, and we miss the initial movement. In such cases, we wait for the new market structure to form and look for a pullback to enter at a better price, with a reasonable risk-to-reward ratio. In other words, we focus on continuation trades during the distribution phase, aiming for higher prices. Now, if you think of this price formation as price action within a trading day, the daily candlestick would look like this. The price opens, makes a high, moves to a low, and then closes high. Our goal is to catch the largest move within the intraday trading range using the power of 3. Now let's move on to the chart and review some real trading examples. But before we continue, keep in mind that this setup isn't limited to a specific time frame. You can use it on both lower and higher time frames. Here, we have gold on the 30-minute time frame. The market is creating a range or consolidation area. 2 rejections from both sides indicate that the price is consolidating. This builds liquidity above and below these boundaries. If we are bullish, the idea is to see manipulation below these lows to engage the sell-side liquidity, and then expect the price to distribute higher. Conversely, if we are bearish, we'd look for manipulation above these equal highs to go short and anticipate the price dropping lower. Let's see how this plays out. Here, you can see that the next two candles break above the equal highs, engaging the buy-side liquidity and trapping breakout traders who thought this level had been broken. Now that the price has returned inside the range, it confirms the manipulation phase. From this point, we'll look for a short entry. In this case, we have an opportunity to open a short position at the close of this candle, expecting the price to push lower. Our stop loss will be placed above this swing high, and we'll target twice our risk for this trade. And there it is. The power of 3 pattern completes with an aggressive distribution move to the downside. An important point to note here is that, like any other trading concept, the power of 3 may not be as effective when used on its own. It's best to combine it with other smart money concepts to achieve better results. For example, if we had a higher timeframe supply zone right here, it would provide an additional confirmation for this entry. This is because the power of 3 pattern aligns with a higher timeframe key level, which has the potential to reject the price lower. Or imagine if the price was in a downtrend on the higher timeframe. In that case, we could have taken this trade with much higher confidence, knowing we were trading in line with the overall trend. This is why it's essential to combine multiple trading concepts to make more well-rounded and informed trading decisions. Now let's look at another example. Here, we have pound yen on the 4-hour chart. From a price action perspective, the market was in a long-term downtrend, but recently failed to create a new low, indicating a loss of bearish momentum. This was followed by a break above 2 key supply levels, signaling that demand is now in control, and a counter-trend formation might be underway. With that in mind, the higher timeframe direction appears bullish. Let's zoom into the 30-minute chart for a closer look. On the lower time frame, we can see that the price is forming a consolidation range, with 2 rejections from the top and 2 rejections from the bottom. Buy-side and sell-side liquidity are resting above and below this range. Once again, we're looking for a stop-loss hunt and a failed breakout to confirm the manipulation phase. Remember, the higher time frame direction is bullish, as we discussed earlier. This means we want to see a liquidity sweep below these equal lows, followed by a push higher. Let's see what happens. At this point, we have a breakout below the range, and the price has pulled back to the support, which has now turned into resistance and is being rejected. This shows that sellers are attempting to push the price back into the range. If they fail, it indicates that buyers are in control. Now that the manipulation phase is confirmed, we can set a long entry at the close of this candle. So in this example, these are our consolidation, manipulation, and distribution phases. This demonstrates how combining the higher time frame direction with a lower time frame entry strategy can help you identify a high-quality setup. Even if we missed this initial opportunity to go long, we could have entered on the following bullish movement. Additionally, if you check the 1-hour chart, you'll see that the conditions were also ideal for going long with the same power of 3 signal. This 1-hour order block could have been another excellent opportunity to place a trade. Keep in mind that when testing a trading strategy, it's crucial to evaluate its performance across different currency pairs, stocks, and cryptocurrencies. This helps determine if it works for you and suits your trading style. A strategy that works well for one asset, such as a specific currency pair, may not be effective for others due to differences in volatility, market behavior, and liquidity. Observe how it performs in different trading sessions, scenarios, and timeframes, and refine it based on your findings. When identifying accumulation, manipulation, and distribution, AMD, on a chart, one key factor to consider is how trading sessions affect price movement. Each session brings different levels of activity, which can influence market behavior. For example, let's look at the euro-dollar on a 15-minute chart. During the Asian session, the price usually moves slowly because trading activity for the euro and dollar is limited. The market often remains in a small range, consolidating without making big moves. This period is quite important, because it sets up the price action for what happens next. Now let's see what happens when the London session starts. The price suddenly moves up, engaging the liquidity above the consolidation range, as well as the Asian high, before getting back inside the range. This shows that manipulation occurs with the opening of the London session and the injection of volatility into the market. Finally, the price distributes lower on the opposite side of the manipulation move. The sequence we see here is Asian session consolidation, followed by manipulation when the London session opens, and then distribution as the price moves lower. By understanding how these phases work and combining them with your trading session, you can better predict price movements and spot trading opportunities. If you find it difficult to identify consolidation on the chart, you can use equal highs and lows as a similar concept. Let me show you how. First, make sure you have identified the overall directional bias and that you are trading in the direction of the bigger picture. If you're bullish, you only need to identify equal lows, which show that liquidity is gathered below this key area. Then, look for a liquidity run below this area. When the price returns inside the range, it confirms that this breakout was only manipulation. What usually follows is a continuation of the higher price movement, which is in line with the bigger picture. Now, the psychology behind this concept is that, in order for continuation movements to happen on the chart, the market needs to gather liquidity. This is because massive buyers need massive sellers present in the market. Manipulation happens until the market accumulates enough liquidity, after which we see the price movement we want. So, in this case, with a similar approach, we identify these areas as accumulation, manipulation, and distribution phases. Our goal is to trade the bulk of the movement, which happens after the manipulation confirmation. But remember, if you missed your first entry, you can also look for other pullbacks to enter at a better price. Just be mindful of the next important level. A key level on the higher time frame has the ability to reverse the price, so we have to wait and see who takes control, supply or demand. Then, we can look for more trading opportunities using our setups. But remember, trading live involves real money and real emotions. It's a whole different game compared to paper trading or simulations. The key to success is sticking to your trading plan, which acts as your blueprint for success. So guys, I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.